All right, let's get right into it. Today, we are unpacking a major institutional research note to really understand the deep structural forces that are shaking up the global markets. We're going to look past the headlines and decode what the big money is really thinking.
Okay, so let's just dive right in with this one-liner from the report because it is so powerful. This sentence just perfectly frames the massive battle we're seeing. On one hand, you have the incredible, world-changing promise of AI's innovation, and on the other, it's just crashing headfirst into these new walls of global tariffs and economic nationalism.
So, that's the big question, right? With AI's potential clashing against these protectionist walls, what on earth does that actually mean for your investments? We're going to cut through all that noise and really pinpoint the true story that's moving the markets.
First things first, we have to make sense of all the confusing symptoms the market is showing. To do that, we need to check the economy's vital signs and, most importantly, learn how to separate what's just a temporary distraction from what's a real fundamental shift.
Now, this slide is a perfect example of what I'm talking about. You look at that headline number, 1.4% GDP growth, and it looks like a complete disaster, a catastrophic slowdown. But that's just the noise. The real signal, what the institutions are focused on, is that a 43-day government shutdown was a temporary drag. The underlying economy? It isn't actually falling off a cliff, at least not yet.
And here we see the exact same pattern, this time in the jobs data. The headline screams, hey, a solid 130,000 new jobs. Everything's great. But the real signal, buried deep in the annual revisions, is an absolute shocker. Get this, 862,000 jobs just vanished from the data. This proves the foundation of the labor market was way weaker than we were all being told.
Okay, so if the data on the surface is just noise, what are the true underlying problems causing all these symptoms? Well, the research note points to two huge, simultaneous shocks that are hitting the global system right now. And here they are, the two big shocks, side by side. On the left, you've got the policy shock. You can see the shipping container that represents the new 10 to 20% universal tariffs, creating just absolute chaos for global supply chains. And on the right, you have the technology shock. And this chart shows something really critical. AI investment, or CapEx, is skyrocketing, while at the same time youth employment is projected to fall. This gets to the core fear. AI is great for efficiency, but what if it just destroys jobs? And that tech shock is being fueled by this terrifying new idea called Ghost GDP. The theory goes something like this. AI will make companies incredibly efficient, yes, but it's going to do it by wiping out so many high-paying jobs that consumer demand just collapses. So you end up with fantastic corporate profits on paper, but there's nobody left to actually buy the products.
So, how are these twin shocks actually hitting the market? Well, we're about to see how its internal mechanics are, quite literally, starting to break down under all this pressure.
So the first critical failure is a really technical event. It's called a gamma flip. But think of it this way. When the S&P 500 broke below that key psychological level, it was like a dam breaking. A huge wall of options that were supposed to act as a safety net for the market suddenly became totally worthless. And worse, the dealers who sold those options were forced to start dumping stocks to cover their own positions, which just pushed the market down even further, creating this really dangerous downward spiral. And all that forced selling is creating this stark, K-shaped divergence in the market. This chart just illustrates it perfectly. You can see how the high exchange rate is a huge benefit for large exporters. Their part of the K is going up. But at the exact same time, smaller companies that really rely on domestic demand are just getting crushed. It's tearing the market in two, leaving a few winners and a whole lot of losers.
So in this kind of chaos, where do you hide? Well, the institutional answer is pretty clear. Gold. This chart shows gold's price just surging past $5,100, with some targets as high as $5,000. But look at what's driving it. It's not just fear. It's also being driven by massive buying from central banks as they try to de-dollarize, and the expectation of lower real interest rates. Gold has basically become the ultimate safe haven asset.
So that's the crucial question, isn't it? In a market that's this fractured and this dangerous, where exactly do the big institutional players say we should take shelter?
And the report is incredibly specific on this. This isn't about broad strokes. The analysis shows a really clear rotation away from sectors being cannibalized by AI, think B2B software, and financials that really depend on consumer credit. The money is flowing into low volatility, defensive names, and unique stories in healthcare that are basically immune to all these big macro trends.
And this all translates into a very concrete prescription for your portfolio. The recommendation is to underweight or reduce your exposure to software and legacy fintech. Then, you overweight or increase your holdings in physical gold to as much as 10% of your portfolio, and you add protective put options to hedge against any more downside.
Now, looking ahead, the report makes a pretty bold argument that the entire market's fate, whether we bounce back or fall even further, now hinges on one single critical event that will determine the future of the entire AI narrative.
And that number, $700 billion, that's the annual amount big tech is pouring into AI infrastructure. It is an astronomical sum of money, and the market is desperately waiting for proof that this spending is actually generating a real return.
And that moment of truth, the single point of failure for this whole thesis, is NVIDIA's upcoming earnings report. You know, it's no longer just about one company. Wall Street now sees this as a referendum on whether that $700 billion AI investment is creating real profit or just fueling a massive bubble. And this leads to two completely different paths for the market. Scenario A, NVIDIA delivers, and the green light is on to buy all the AI infrastructure plays. But in Scenario B, if their guidance disappoints, it will trigger a huge crisis of faith in the entire AI story, and the recommendation is to immediately flee to high-dividend defensive stocks.
So what's the final takeaway from this really deep dive? And maybe more importantly, what's the one catastrophic risk that the report warns the market is completely ignoring right now?
The report concludes with a really chilling black swan warning. Hiding out there in the unregulated shadow banking system is $3.8 trillion in private equity assets, and many of those are loans to the very same software companies that AI is disrupting. If those companies start to default, it could trigger a 2008-style liquidity crisis that just cascades through the entire financial system.
And the final thought is this famous quote. For the past year, the market has been in a state of pure euphoria about AI. And the report argues that today's turmoil, as painful as it is, marks the necessary and frankly overdue return to skepticism. It's a painful reevaluation for sure, but that's how a healthy market is supposed to work. The key now is to stop focusing on the narrative and start focusing on the numbers.